Well, good evening, ladies and gentlemen, and welcome back to Foundations of Stocks and Options. I hope you're all doing absolutely fantastic this evening on this fine Thursday evening. And Thursday evening, what is it, November the 6th? I hope you're all doing absolutely awesome. Dale wants to know where I'm at. I'm here, Dale. I'm here, buddy. 1 minute late, and I got Dale all upset. Sorry about that, Dale. Anyway, let's get rocking and rolling. We're getting into class number 7 tonight. That means we're really rounding the corner on this level 1 program, and that means we're going to start talking about stock options. That's going to be an awesome class tonight. I'm looking forward to it for you guys. So here's our agenda. We're going to talk about the risk of stock. We're going to talk about insuring your stock, and then we're going to get into an introduction into options. So this is going to be some fun stuff that we're getting into here this evening, and I'm certain that all of you are going to enjoy our little chat. Real fast, kind of quick informal survey. Just type it into the chat here. If you've traded stock options, say yes. If you've never traded stock options, say I'm a newbie. That kind of gives me an idea of what I'm working with and who's here this evening. If you're experienced, then I may go a little faster through some stuff. If I got a lot of newbies, I'll probably take some stuff a little bit slower here. So, all right, just doing a quick read through here. It looks about like roughly a third of you are maybe closer to half. I got not a newbies here at the end. Okay, so I think at least half of you are probably brand new. That's great. I love newbies. There is nothing in my life that is more exciting than watching a new trader discover the power of stock options. When you understand this, your entire world of how you understood trading will change. And I'd like to ask you, how many of you feel after the last class when we learned about trading plans, looking back at your level 1 of Foundations of Stocks and Options, how many of you feel like you're much better prepared now to move forward? How many of you feel like you got at least a rudimentary understanding of how to do your analysis? How many of you feel like you've got an idea of how to pick a general direction, up, down, or sideways? Maybe you're not an expert yet. We don't have the advanced analysis tools yet, but you got a basic idea. And after the last class, now you can even do your basic first trading plan. All right, so we're making a lot of progress. Now, tonight what we're going to do is we're going to start to layer it on. We're going to start to take you from intro to more intermediate and ultimately on up to more of an advanced level of trading. We're not going to go all the way there tonight, but tonight's kind of the beginning of that transition. When we start talking about stock options, we're bringing in a new market. You know, up until now, we've just been talking about stock. We're talking about buying stock long and selling stock short. Options are what we call a derivative. They're based on the stock, but it's a derivative market. And, instead of being based out of New York, most options are based out of the Chicago exchanges. It's just a different market. But here's the good news. Options are an instrument. We're going to learn how the instrument works, and the analysis is the same. And I really want to encourage you. Oftentimes I get students that are saying, hey, I'm not interested in trading stock options. This isn't practical. And they're missing the idea and the understanding that all of the analysis is the same. All I'm giving you with our teaching on stock options are some more strategic tools. And so it's going to be really, really valuable for you. And I'm looking forward to sharing it with you. All right. Anthony says he is definitely, in response to my question about having understood some stuff after the first 6 classes, Anthony says, yes, definitely. He's already made $2,200 with PM. So there you have it. Anthony has already made $2,200. All right, let's get rocking here. Let's talk about the risk of trading stock. Do you think trading stock has any risk? Yes or no? Yeah, of course. There's always going to be some risk. There's going to be some risk. What is the risk of trading stock? Well, first of all, you need to understand when you buy a stock long, yes, you own part of the company, and as the stock goes up, your profit goes up. This is kind of the reward of buying stock. Let's take a look at this example here with Hess. So if we draw some support in here, we're going to have support around $54 a share. We'll have some up here around 62. And if you're looking at this trade and you see, hey, I've sold off into my support level, I start to make the turn. Is it safe to say that we can enter the trade roughly right around here, maybe right around $56 a share? I think it's probably a pretty good spot. So we say if I trade above $56, I will trigger my trade and get into a bullish trade. Now, where's our next target going to be? Based on what we've learned, we're going to trade up to about $62, maybe $66. Those will be our targets moving forward. Well, let's see what happens. Sure enough, the next day, the stock starts to trade a little bit higher. We trigger our trade at $56, and it only takes, 1, 2, 3, 4, 5, 6, 7 trading days before we trade up to our first target at $62 a share. Congratulations, you just made a great trade. Now, what happens if we tighten the stops and we hold it and we trade to the second target? Well, turns out just a few days later, we're up at $65 a share, and we get some exit signals and we can exit the trade. So let's look at the reward, and then we're going to talk about the risk involved of trading this trade here with Hess. Had we purchased Hess at $56 a share, let's say we bought 100 shares. If you want to buy 1,000, I'm good with that too. But we'll just say you bought 100 shares. If you bought 100 shares of Hess at $56 a share, anybody who does basic math will tell us that's going to be $5,600, right? So we ride the Hess trade up to $65 a share, and we sell it. We sell it for $6,500. That's $65 a share. We bring in a profit of $900. I don't think anybody's got a problem with that math. That's really simple. That's really straightforward, right? Now, let's understand the return on the investment. How do we get the return on the investment? The formula is really simple. We take our profit, we divide it by the investment capital, whatever amount of cash it was that it took to do the trade. So in this particular case, it took us it took us 56. I'm getting dyslexic here. Took us $5,600 to do the trade. We made a $900 profit, so we're going to divide $900 by $5,600, and we got a 16% ROI. It took us about a month. How many of you would be pretty happy if you could find trades like this and you could make 16% maybe every month, maybe every 2 months? How many would be pretty happy if you make 16% every month or two? Yeah, that's not too bad. Most people would be really, really happy with that trade. But let's not kid ourselves. There is a risk involved. What is the risk of trading this stock? If we go out and we buy Hess for $5,600, what's the worst that could happen? What's the most that we could possibly lose? Any ideas? Edmund, what's the most you could lose on this? What's the most? You could theoretically lose all of it. Now, what's the likelihood that you're going to lose all of it? The likelihood is relatively low. You know, it's not common that a $56 stock goes out of business overnight. That's pretty uncommon. However, there are stocks that are at $56 a share and they start trading down and people hold them and they keep thinking it's going to come back and it never comes back. And before you know it, a year or two later, they're out of business. You can lose all of it. And if you stay with a bad trade long enough, eventually you might as well lose all of it. Ask the people who were buying Enron all the way down to the bottom, right? Yeah, so the truth is your ultimate risk is all of it. Now, in reality, that's probably not practical. We're probably not going to actually lose all of it, but that is your ultimate risk. And because of that, we say that there is a limit to the risk. The most we could lose would be all of it. No one wants to lose all of it, but we can look at our risk profile and say if the stock goes down, the most it could go down to is 0. That would be our maximum risk. Therefore, our risk is limited. Now, how high could the trade go? The trade could go unlimited. There's no cap to how high the trade could go. So when we talk about the risk of owning stock, the risk profile is a limited risk with a theoretically unlimited reward. And I say the word theoretically because in both cases, you know, we're probably not going to lose all of it, and we're probably not going to buy the stock and at $56 a share, it suddenly shoots up to, you know, $5,000 a share overnight. Neither one of those are probably going to happen, but theoretically speaking, they could happen. Now let's talk about selling stock short. What's the difference here? Well, when we sell stock short, instead of owning the stock, we borrow the stock, and of course, we can make money as the stock goes down. As the stock stock goes down in a short trade, our profits are going to go up. So let's take a look over here at our Hess trade. As we trade up into resistance, we start to get some candlestick signals that tell us maybe this trade's going to start turning down. We're at a known resistance area. We're in the pivot area, and we can say if the stock starts to trade down, then maybe I'll go into a short trade. So let's put a little trigger in here, and we'll say if I trade below $64 a share, then I'm going to sell short. This is not new. This is what we've been talking about for the last couple of weeks together. It's just a basic trading from support up to resistance and from resistance back down to support. Well, let's see what happens. Sure enough, well, let's look at our targets. Next target's 62, next target's 54. Sure enough, a couple of days later, we zig and zag a little bit. It takes about a week, but we trigger the trade bearish. Doesn't take too long. About a week and a half later, we're into the first target. Maybe a month later, we're down into the second target, and we exit the trade at $54 a share. This was a good trade, Lorenzo. I'm proud of you for doing it. It was a good one. Let's go look at our profits on this. So we started this trade by shorting. When we open a short trade, does cash come in or does cash go out? Does cash come in or go out? Cash comes into your account. Very, very good. I want you guys to always understand that. When you enter a short trade, cash comes into your account. You can't use it, but it comes into your account. And so you're sitting now on a pile of cash of about $6,400 since we sold 100 shares of a $64 stock. Well, let's see what happens as this trade goes down. We have to go do what? We can't just stay in a short trade forever. At some point, we have to go back and buy the stock that we sold. We sold it to open it. We're going to buy it to close the trade. That's called buy to cover. Correct? So we're going to buy the stock now at $54 a share. Now money is going to go out of our account. So out of the $6,400 that we brought in, we're going to spend $5,400, and the difference is $1,000. This is your profit on the trade. Good job. How many of you would like to go make $1,000 selling a stock while the stock goes down and it only takes you about a month to do it? That's not too bad, is it? Yeah, and you didn't even have to use the money out of your pocket. You had to put some money on reserve, but you didn't have to have the $6,400 to do it. So congratulations, you just made some money while the stock went down. Now, what happens if the stock keeps going down? What if you get down to a support level and take a look at this FedEx trade? The trade's been in a bearish trade. We start pounding into support, and then, big bearish gap. Obviously, we need to sell this sucker. Let's keep going. I mean, stock breaks below $72 a share support level. I mean, this thing's probably going down to, I don't know, $30 a share. Maybe it's the end of the company, right? So you're thinking, I'm going to short this sucker, and I'm going to go in heavy on it. And what ends up happening? Well, you enter the trade at $67 a share. It's a 30% drop from where we had been. You're thinking this is going to be good. But let's watch what happened on this particular trade. You enter short at $67 a share, but just as soon as you enter it, it rallies. It comes back down, and you're starting to think, okay, yeah, this is doing exactly what I thought. You actually have a profit for a couple days, and then the unthinkable happens. The stock starts to rally, and it rallies above resistance, and it keeps going. And at some point, you're knowing that since you sold it short, what do you have to come back and do, Edmund? You sold it short. You got to come back and do what? You got to come back and buy to cover. And you only sold it for 67. The fair market price now, or the open market price, is 78 and climbing. You finally freak out. You buy to cover at 78. We got a problem. We only brought in 6,700. When we go to buy it, we have to put more money into the deal, and we end up losing $1,100 on this trade. Now, could we have lost money on the long trade as well? Absolutely. Ironically, people get all upset when they lose money on a short trade, and all they see is the risk that the stock goes up and I lose money. And they get all upset about this. But you realize we could have lost the same percentage of money on a long trade if the long trade went bearish against you. And so there's really nothing, different in terms of buying a long trade versus selling a stock short. It's just being on the right side of the trade. Now, here's where a difference comes in. My question for you is how high could FedEx have gone? And how high could it still go? Could we go to $87 a share? Yeah, we could. We did. Could we go to $96 a share? Yeah, we could. Could we go to 108? Yep, we could. Could we go on up to 500? Yep, we could. What's the highest it could go? And the answer is unlimited. There is no limit to how high FedEx could go. So, understanding that, nice little animation there, understanding that the risk of selling stock short is theoretically unlimited. Theoretically unlimited. Why is the risk theoretically unlimited, John? It's theoretically unlimited because there's no limit to how high the trade could go. And what's the reward? The reward is going to be theoretically limited because the lowest it could go would be all the way down to zero. Now, in practicality, in the real world, is the stock going to go from 67 to 160 overnight? No, that's probably not going to happen. It's an extremely rare case if that were to happen, but it's probably not going to happen, right? Could the stock go from 67 to zero overnight? In theory, it could, but it's probably not going to happen, right? And so in the real world, we're going to be trading basically from pivot area to pivot area, and we're going to limit our risk with stops. That's one way that we limit our risks. But I want to teach you the principles here from a theoretical standpoint that when you sell a stock short, you've got a theoretical risk that is unlimited. That says unlimited, even though it doesn't look like it. And you have a theoretical reward that is limited. Because of this risk profile, and understand that selling a stock short is the opposite risk profile of buying a stock long. Because of this risk profile, most people have a deep-seated fear of selling stock short. Just talking about the risk, how many of you got a little bit nervous? How many got a little bit nervous just talking about the risk? Anybody? Yeah, a few of you. Yeah, just a little bit. I did it first, said Robert, but now I'm doing better. Paul said I got nervous. David said he got nervous. Robert says not now, he's doing well. Tim says he twinges. Well, let's just put this to the test. You know, whenever we deal with money, it's a funny thing because people, we get all upset about money and, we work hard for it and, we don't want to lose it. And so what happens is we put all sorts of rules around ourselves and we try to pretend that those rules are reality. Let's just ask ourselves about two trades. On this particular trade, we're going to place a long trade where we enter the trade at 100 and our target is 110 and we set our stop at 95. And so if we enter the trade at 100 and we have a target of 110 and our stop is 105, would someone please tell me what our risk is on this trade? What is our risk on this trade? Our risk is going to be $5 per share. And what's our expected profit on this trade? Our expected profit would be $10 per share. Nobody's going to argue that. Now, what if we take the same idea and we apply it to a short trade? What if we have an entry price up here of $110 a share, and we've got a target down here of $100 a share, and we put our stop up here at 115? What's our risk, and what's our potential profit? It's the exact same. We've got a risk of $5 with a profit target of $10. So why is it that if you guys go set up a trade with these three price points, your entry, your target, and your stop, and you set your trading plan up the way I taught you in the last class, why is it that people have more fear around this particular strategy and a lot of peace of mind around this particular strategy? I don't get it. Other than, in theory, we could theoretically lose, we could theoretically have an unlimited risk associated with selling short, and we have a limited risk with buying stock long. That's the only explanation, but it's all theory. In reality, how many of you are actually going to go out and sell a stock short, and if it starts to go higher, you're going to just keep holding it, hoping and praying that the stock goes down? Who's going to do that? Hopefully none of you are going to do that because I've taught you better than that. I've taught you better than that. You have the same opportunity with both of these trades. Both of them have the same probability of going up or down. You can limit your risk and your reward with both of the trades the exact same way, and yet, in study after study, it has shown that people are petrified oftentimes of selling stock short, and they totally have peace of mind of buying the stock long. Please tell me really fast, what are the odds of a stock, if you enter a long trade, what are the odds of making money on that trade? Roxanne, let me help you out, dear. We are in Foundations of Stocks and Options, Level 1, Class 7. Level 1, Class 7. I see that you've been getting some bad information. We are in Foundations of Stocks and Options, Level 1, Class 7. If you need an updated notebook, it's in your email, okay? Come back to my question now. If we've got a long trade, what are the odds of making money on that trade? Edmund suggests 30%. He's pretty close. The stock could go up. The stock could go down. The stock could go sideways. If it goes up, we got a 33% chance that's going to happen. We got about a 33% chance that it's going to go sideways. And we got a 33% chance that the stock's going to go down. What are the odds if you sell a stock short that the stock is going to go down, or it's going to go up, or it's going to go sideways? It is exactly the same. So here's what I'm telling you. What I'm suggesting to you is when you set your trades up with a trading plan, you have a defined entry, you have a defined target, you have a defined stop. The risk of selling stock short is not any higher than the risk of buying stock long. You want to know when the risk comes in? Let me show you where the risk comes in. And if you will listen to what I'm saying right now, I am unpacking a world of bad psychology for you that will set you free. Here's how the risk comes in. You have an entry at $100. You've got a target at $110. On the short trade, you've got an entry at $110. You've got a target at $100. Does anybody see the problem with this trade? What is the problem with this trade? Somebody please tell me. Henry doesn't see it. Somebody please tell me the problem with the trade. There's one thing right here that turns these trades that all other things would be equal. The same probabilities exist. We got three directions the stock can go, up, down, and sideways. What's the problem? You guys are bouncing all around it. Finally, Anthony's got it in there. There's no stop. There is no stop. When you trade without a stop, you leave yourself vulnerable for anything to happen. And so the bearish trade takes on an unlimited risk, and the bullish trade takes on a limited risk. But tell me, if you don't have a stop on this bullish trade, how low are you willing to let this thing go before you reach that limited risk? Ladies and gentlemen, it's fascinating to me. It's a mystery to me, frankly, that we've got a stock market that's had the same basic rules operating for well over 100 years, and our society, with all the wisdom and knowledge and education that they have, our society as a whole still believes that this trade is more risky because of the theoretically unlimited risk profile. It's a mystery to me. And the reason they believe that is because of a lack of a discipline to set a stop. In reality, both of these trades have the same amount of risk if you trade it correctly. And yet what's happened, our society comes out and they say short selling is super risky, it's bad for the market, blah, 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 blah. The problem was never short trading. The problem was the trader who did not have the discipline to get into the trade with a defined entry, a defined target, and a defined stop. Do you understand what I'm getting at here? What I'm getting at here is we bring onto ourselves all sorts of unnecessary heartache. We put all sorts of unnecessary boundaries on what we're willing to do and to not do simply because of our own shortcomings. But rather than dig deep and figure out where our shortcomings could be fixed, we like to blame the market. We like to blame the market makers. We like to blame the strategy. We like to blame big corporations and all sorts of other stuff. You guys understand where I'm going with this? Now that you understand that, let me go a step further and let me give you an even better solution. How can we limit that risk even further, Robert? How can we limit that risk even further? Kimberly says, but companies are trying to increase their stock prices for shareholders. Kimberly, companies are trying to increase their stock prices, but tell me, Kimberly, you've been with me long enough now. Tell me, what drives the value of a stock? Is the price of the stock driven by what the company's doing, or is it driven by what the traders are doing? Honestly, it's driven by the sentiment, right? Yeah, so companies will do all sorts of stuff to try to increase their stock value, but it doesn't mean it's going to work. Trader sentiment's what drives the price there, Kimberly. So let's ask the question, how could we lower our risk even further? Well, what if we had an insurance policy? How many of you would like to have an insurance policy that said, if the trade goes wrong, I could have some insurance? For example, we go out and enter a long trade and we buy over here and we think the trade's going to go up, but the trade starts to come down and now we're crying because we're losing money. Nobody likes to lose money. We forgot to use stops. And we're telling ourselves a story that goes a lot like this. Oh, if only I could go back in time. If only I could go back, I would have sold this trade back here. I know. I've done it. I've cried that story. We've all been there. We've all done that. But the problem is you can't go back in time. You didn't set yourself up that way. But that's the story you're telling yourself. If I could go back in time, I would sell. Or if you get into a short trade and you go short, you think the stock's going to be falling, but suddenly it starts to rise and you start crying and you're thinking to yourself, oh man, if only what? If only I could go back in time, I would have bought to cover my position. Well, what if we had an insurance policy that said you could go back in time and do that? What if we have a long trade that says, I'm going to sell you an insurance policy that in the event that your long trade goes bearish, you can go back in time and you have the right to sell it for more. That'd be pretty darn cool, wouldn't it? Gary would like that insurance policy. Or with a short trade, what if we had an insurance policy that said, I'd like the right to go back in time and buy for less if the stock goes up? That's an insurance policy Joe could get behind. So how many of you are ready to pick up your phone right now and call your Nationwide insurance agent? Say, hey, Nationwide, you're supposedly on my side. I'd like to buy some insurance for my stock. Or maybe call State Farm or Allstate. I'd like to buy some insurance for my 401k. They're going to laugh at you. Don't do that. Don't make a fool of yourself. I know some of you are thinking, let me find my insurance guy's number. I need this thing. What if you call your broker and you say, hey, broker, I need to buy an insurance policy? Your broker's going to laugh at you. But Ken, what if you call your broker and you say, broker, I need to buy some stock options. Your broker's going to say, Ken, what did you have in mind? And Ken, you would be effectively moving out of the equity market and into the insurance market. In the most simple explanation, a stock option is simply an insurance policy on your stock. You call your broker, you say, I want to deal with some stock options. They're going to say, what'd you have in mind? They're not going to laugh at you. And we can use those options as an insurance policy. So the rest of tonight's class, I'm going to start introducing you to these really cool things called stock options. And what it's going to do when you start to understand stock options is it opens up an entirely different market that we can trade, and it just brings all sorts of opportunity. All right, so let's get rolling with our world of stock options here. Let me give you a quick disclaimer here. I do want you to understand that options do involve risk. They are different than trading stocks, and it is critical that you understand option trading. It's critical that you have a well-rounded understanding of options before actually trading them. I want to highly encourage you to complete all 3 levels of foundations of stocks and options and practice in your virtual accounts before placing your option trades. And here's why. Because what I'm teaching you in level 1 is not enough for you to go out and become an options expert. I am giving you a general introduction and a general explanation. Now, the entire Foundations program will finish this thing off, but I don't want you, after tonight's class, to go out and suddenly go enter a bunch of option trades without knowing exactly what you're doing. And so that's just my way of warning you that I'm not giving you a complete book tonight. I'm getting you an introduction. Okay, so what you do with your money is up to you, but consider yourself fairly warned that I'm giving you an introduction. Okay, and Rand says he's already done that. He said, haha, like I did, losing $2,800. Rand, that $2,800 would have been a lot cheaper if you'd just come to the Foundations class first, wouldn't it? Yeah. All right, so let's start unpacking this. What are stock options? Here's my definition for the stock option. And then the rest of tonight's class, we'll start to unpack all this. The buyer of a stock option purchases the right, but not the obligation, to buy or sell a specific stock at a specific price on or before a specific date. That definition is in your notebook. If you don't have a notebook, write that definition down, because everything in tonight's class is going to derive from this definition. Okay? The right, but not the obligation, to buy or sell a specific stock at a specific price on or before a specific date. Now, we're going to jump into the deep end of the pool, and then I'm going to pull you out, but let's jump in together. There's 2 types of options. We've got calls and we got puts. A call option is the right to buy a stock at a certain price, and the put option is the right to sell a stock at a specific price. So we got the general definition, the right but not the obligation to buy or sell a specific stock on or before a specific date. Then we got specific types of options. We got the call option and the put option. The call is the right to buy. The put is the right to sell. Now let's go one step further. There are 2 directions or 2 sides of the trade. We got the buyer of the option. We got the seller of the option. So in total, it doesn't take a rocket scientist to figure this out. There are 4 trades. We can buy a call. We can sell a call. We can buy a put. We can sell a put. This is all you can do. This is it. Buy a call, sell a call, buy a put, sell a put. I don't care how complicated of an option strategy you have somehow figured out to concoct, but every option trade ultimately comes down to these 4 trades. Buy a call, sell a call, buy a put, sell a put. Now, what's cool about it is these 4 trades can be expanded into what seems like an infinite world of option strategies. I've got books that are 1,000 pages that are full of option strategies. But these option strategies, most of them aren't worth anything, to be honest. But they're all just a combination of these 4 trades. Buy a call, sell a call, buy a put, sell a put. So understanding that, we can start to piece together how the options will work. We can keep it pretty simple. So I want to take this definition that we just had, and I'm going to expand it. Now, watch what I'm going to do here. You ready for this? I'm going to underline key components of this definition. The buyer of the option buys, you ready for this? Here's the definition. The right but not the obligation to buy or sell a specific stock on or before a specific date. If you buy the right to buy, that is what kind of option? That's a call. If you buy the right to sell, it's a put. Now, the reason I've underlined with these colors, I want you to recognize that the blue is the option definition, the right but not the obligation to buy or sell a specific stock on or before a specific date at a specific price should also be in there. Now watch this. If the buyer purchases the right, then the seller does what? The seller sells what? The right but not the obligation to buy or sell a specific stock on or before a specific date. If you have the right to buy, it's a call. If you have the right to sell, it's a put. Notice what's happened. This area that I'm putting in blue, that is the definition of the option. And the area in red, I'm just defining the buyers and the sellers. The buyer buys the option. The seller sells the option. The option itself is the right, but not the obligation to buy or sell a specific stock on or before a specific date. That's what the option is. The buyer either buys that option and the seller sells that option. If the buyer buys the option, he receives the rights to buy or sell. If the seller sells the option, what's the seller doing? The seller is selling the rights, but not the obligation to who? To the buyer. You see what's happening? The seller sells the option. The definition of the option is the right, but not the obligation to buy or sell a specific stock. The seller sells the option. The buyer buys it. The buyer has acquired all these rights. The seller has sold the rights. Consequently, the seller has become obligated. I'm letting that one sink in for a minute. The seller is obligated to the buyer because the seller sold the rights. So, let's come to my next slide. This is my little Rosetta Stone of option trading. This will unpack everything for you. When you buy a call, you have purchased the right to buy the stock. If you buy a put, you've purchased the right to sell the stock. If you sell a call, remember we're selling to the buyer. The buyer purchases the rights. Consequently, the seller is obligated to sell. The buyer has the right to buy. The seller is obligated to sell. If the buyer buys a put, the buyer of a put receives the right to sell the stock, so the seller of the put is obligated to buy the stock. Whoo, we just went straight to the deep end, didn't we? We jumped in head first, and some of you hit your head on the way down. Who's confused? Who needs a lifesaver? I'm going to pull you out. I'm just curious, who's confused? If you're confused, it's okay. Ken says he is not confused. All caps. He's excited. Ken, I'm proud of you. Sandy's a little, she's treading water. Ernest, is it Ernest? Who's E. Brown? What's your first name? I think it's Ernest. Is that right? Ernest? Jennifer says she's a little foggy. Daniel says he's a little confused. That's all right. Earl. Forgive me, Earl. I got the wrong E name in there. Bob says help. All right, guys, let's leave the world of stock for a minute. Just let all that sink in. And I promise I've taught a lot of people how options work. You're going to get there. We're going to get there. But let's leave the world of stock and let's go to the world of real estate. Sean, you got a new guy, shows up, says he wants to buy a house from you. His name's Bill. Sorry, he didn't want to buy a house. He wants to sell it. So Bill wants to sell a house. He's got this little Orlando McMansion that he bought back in the real estate boom of the 2006 era. He paid $200,000 for the house, and he watched the house go up in value. He was all excited, thought it was his retirement plan, and then it started crashing down. And here we are, 2014, and Bill's still sitting on this house. He's just wishing that he could get back to those $350,000, $400,000 days. And now he's hoping he can close the deal for what he got into it, $200,000. He's been sitting on the house for several months, had it on the market. Nobody wants to buy it. And along comes Joe. And Joe says, hey, I think I might want to buy this house, Bill. And Bill says, that's fantastic, Joe. I understand we might want to buy my house, but you're not ready to do it today. And Joe says, yeah, I would like to buy your house maybe, but I'm not ready to do it today. So I was thinking, what if you just take the house off the market? Bill's not going to do that. No, he's got to have some incentive. So Joe says, okay, Bill, I was thinking I will pay you $5,000 to not sell your house. And you're going to hold your house for 3 months. And in 3 months, I will come back and I will pay you $200,000 or you will keep my $5,000 and you never hear from me again and you can sell your house. Bill says, wait a second, let me understand. You're going to pay me $5,000 and if you come back, I keep the $5,000 and you pay me $200,000 for my house. And if you don't come back, I still keep the $5,000. And Joe says, that is correct. How many of you think that if you're Bill, you're going to do this deal? Would you guys do that deal if you're Bill? Yeah. Let's understand what just happened here. Let's look at what's just happened. If I can get my drawing tool to come up. There we go. All right, so Bill, he owns his house. And Joe wants to maybe buy the house, but he doesn't own the house. Joe has some money. So Joe takes $5,000 and he transfers it from Joe over to Bill. And Bill now has $5,000. Bill now takes this house and he puts it over here and he says, Joe, you have the right to buy this house at $200,000 if you come back and do it. And this right to buy has gone over here to Joe. Now, if Sally comes along and says, Bill, I'll pay you $300,000 for your house, does Bill have the